In an interview with CNBC International, Cathie Wood defended her Ark Invest Fund's poor performance but made it explicitly clear not to disregard her 5-year time horizon. At the beginning of the pandemic, Ark Invest exploded with 360+ gains. The stellar performance plus her transparency put Cathie Wood on celebrity status, especially with the younger generation. Although she received much praise, she also drew haters. Fellow analysts and talking heads argued that her portfolio only performed as such because of the pandemic, and her methods of investing really had no merit. Fast forward 2 years and Ark Invest is down 60%, making it very easy for analysts and talking heads to scream "I told you so." Despite her 30 years of experience in markets, some even went as far as calling her an amateur, and true believers are terrific. But Melissa, the problem is that, as one of our guests said earlier, there are no bids for the true believer. The only real buyer of some of this merchandise is Cathie Wood. You cannot create a market yourself. Nobody's that big. I do. When I see her buying things, I am shocked at what she buys and how she buys. She buys like someone who just started yesterday. Despite the hate, Wood firmly believes that the reason her fund performed so well was not because of the pandemic per se, but rather because the pandemic created so many problems that innovation fixed, and she believes it's only a matter of time, 5 years, before innovation will once again come to the rescue to solve our geopolitical, climate, health and financial problems. Listen to what she has to say. Let's put in perspective. You mentioned 60%, which is absolutely right. We have been in a terrible bear market for innovation. Hard to understand, but terrible. I'll book bear market for innovation. However, if you look from the bottom of the coronavirus to that peak in February of 21, we were up 358%. Why? Because innovation solves problems. Right now we're down 60%, and we have a whole new set of problems certainly coming out of Russia and Ukraine. If you look at our strategy over a 5-year period, look at the last 5 years. I'm not quite sure what the numbers are, but they are well above our minimum hurdle rate of return, which is 15 at a compound annual rate, and I think over 3 years we're closer to 25, so that helps put our performance into perspective. You know, this is a period if you believe in innovation, and in that innovation does solve problems. We had a preview of that after the COVID crisis when our strategies, and in the span of a month many of the stocks were taken down 75% because either they were burning cash or they had low cash cushions. But guess what? Those were the genomics companies that were going to get us out of the coronavirus. And today what do we have? We have all kinds of problems, the latest of which is Russia, Ukraine, and all of the commodities coming out of that area, especially hitting Europe. I think we're going to be looking at a lot of demand destruction and substitution into innovation. Electric vehicles as opposed to gas-powered vehicles would be the biggest one. We also have labor shortages all over the place. Again, automation. This is innovation at its best, and it's being turbocharged by this environment as the market is really hitting our stocks. So I think if you were to look at the next 5 years, and if you were to give us that 5-year investment time horizon, we are the closest you'll find to a venture capital fund in the public equity markets. If you were to give us that 5 years, given our expectations for growth in these new technologies, I think we're going to see some spectacular returns. Typically the way we see the peak is through the VIX, the volatility index, and it has moved up. It's in the mid-30s. I'm not sure what this morning is, in the shock in 2018 and in the one before that got us into the low 40s. Of course the coronavirus got us to 80. But we're getting close to those cathartic moments in the past. I would be surprised if we do go to the coronavirus, because remember levels, because remember people were expecting a depression. The whole world shut down. This is not that. This is going to cause a lot of problems from a purchasing power point of view. I think the risk of recession has gone up dramatically as purchasing power is dropping dramatically in the U.S. The consumer saving rate already is down to levels we have not seen since 2013. So that buffer that the stimulus payments created during the crisis, that's gone, and so consumers are probably going to pull back. Sentiments suggest they will, and in some ways, they already have. If you average over the last 3 months, this is U.S. consumption in real terms has been pretty flat. What do you think of Cathie's thoughts here? Leave a comment. That's it for today. We'll see you in the next video.